Hey guys, I trust you are all well and welcome to Live Trading Profits. What I want to do today is just take you through a trade that I've just taken. I thought I'll just show you. Taken this morning, 11:25 and closed 11:56. So that's 30 minutes time, and there's a profit that I made on that particular trade. But I would like to walk you through it, just so that you can understand my thinking, my rational processes. Presently, I'm still looking to sell. So what I do is, see these big icons here, sell. I can just show you very quickly, because I'm looking at 8 different markets. So I just plonk those directional indicators. Okay, the market has moved a bit, so you probably won't see it, but let me do this. So for example, okay, euro we're gonna look at just now. So this is what my active dashboard looks like, if you want to think of it that way. So I can just have a look at the 8 markets. That's Bitcoin. I haven't looked at it today, so it's not on my radar. And I can quickly see if any of the markets have reached the area where I want to buy. So if I'm buying, I want to be buying down here. So it's a bit of a while to wait. This is gold. Gold is pretty close, relatively close to the area I want to look to buy. But it needs to come down into this zone for me to buy. And if it accelerates up, well, I'm going to miss it. Same here. Now, euro, I had the very same thing. And euro, my goal was to sell. So I took a trade here, and that's that particular trade that you see down there. Now, there's another trade opportunity here, and I was out on the road racking. I put a rucksack on my back, weighted down, and that's my exercise. But we'll get to that. So if you were in the market, you'd have seen that opportunity. So let me just take you through the reasoning behind this trade. Now, what I'm going to do for a while, or for a few seconds, I want to just switch the screen share and explain to you part of the thinking. So this is the whole thinking for the day. Okay, so some of the basics we now know: high of yesterday, low of yesterday. There is the midpoint. And just this line here is when you get to the today, it's a high of today. And you also see the open of today. Okay, so these are things that you ought to be doing standard now. If you trade in 5-minute time frame, high of yesterday, low of yesterday, midpoint, and the open of the day. Now, something else that I introduced a few weeks ago is how we ought to look at the prior 3 days, because the previous 3 days will give us insight into how we should be trading. Now, I've got 2 charts open here. I'm not sure, 2 PowerPoint. Let me just see if the correct one is open. Euro versus dollar. Great. Okay. So trust you all see my PowerPoint. Now, what I do is every day, I'm in the market. During the day, by end of the day, I'm going to save screenshots. I'm going to analyze them. I'm going to just add them to my PowerPoint presentation. So now The one that I have for March is probably now got about 500 slides to it. And that's a discipline that works for me. For some guys, what I used to do way back when I started, I just print the charts and write on them, just have files and files of charts printed and analyzed. You don't have to memorize them, but the more you do that, the more these things are gonna stick in your mind, and you're gonna restructure the way the neurons firing in your brain work, so that you can start to understand the market even better. So I explained a few weeks ago that you always look, try and look at the last 3 days before this day. So you have, this is the daily time frame, you have the full view of what's happening on the daily. You can see that we are in a bear channel, and the way you draw a bear channel, you know, because it's lower highs, you connect those lower highs, those two lower highs, you extend the channel down, and then, you know, the other line, you just pin it to a higher low. So the goal, the objective for the bears coming into today, you know, the bears are strong, they want to get to that channel line and test it. And if the bulls are strong, when you get to the bottom of the channel line, they will reverse the market. So that's broad framework. What else can we look at in terms of the broad framework? We can see that, you know, after this 2-bar reversal, that's there, and the market then went down, but the market going down into April, we had a trading range forming where the market went sideways. So strong bear breakout, and then a pullback, a trading range pullback to the 20 EMA. So whenever you see a trading range, you always have to automatically just put your measured moves in. And there's the measured move, low of the trading range, high of the trading range. If the bears break beneath the trading range, because you've put this way before, they want to get to that level. Okay. Now, why is that important for where we presently are? It is important because at the bottom of the channel, where that's going to pull the market down, the bears want to get there. There is also another magnet, which is the measured move of that trading range. And we know every time there's a break out of a trading range, the objective is to get to a measured move. Will the bears get there today? We don't know. Will they get the end of the week? We don't know. But there's a magnet there. So we have strong levels of support that act as a magnet to pull the market down. In addition to these two, remember, high of yesterday, low of yesterday. So that's yesterday. The measured move of that is here. If the bears are able to break beneath the low of yesterday, they want a measured move of the trading range of yesterday. So that would take them here. So you have this level of support drawing the market down. You have this level of support from the trading range. You also have the channel. So a lot of forces that can pull the market down. Now, having decided that, always look at the previous 3 days. So this is today. Look at the previous 3 days. There is a previous 3 days. Confirmation of bear strength from that lower high, bear breakout, bear follow through, strong breakout. So we know that the bears are strong. Now, having done that, you then come to your daily time frame. And one of the most important things to do is look at the first candle of the day. It doesn't matter what time you come into the market, it could be coming now. But go back and look at the period separators and find the very first candle of the day. Okay. And the pattern at the open, the first 18 candles, and see if that first candle corresponds to the 3-day analysis. Because if it does, there's a higher probability of unfolding into the day. So because this is strong bear candles, 3 bear candles breaking beneath the trading range and follow through, I'm interested in seeing if the first candle of the day is a bear candle. So that will be a big tick that the bears who've been creating all of this managed to control the first candle of the day. My candle, 5-minute time frame. Then I want to look at the rest of the patterns there. The open first 18 to 24 bars or candles, that's the first 2 hours, and see if there is still further confirmation that in this case, if the bears are controlling the first candle, then control. Okay. So that's just something that you have to work through over and over and over again. Now, keep that in mind, and let's go back to today. Okay. Now, for those guys who've just joined, I want to talk about this trade that I took here and made a 2-to-1 profit, a 1-to-1 profit anyway. So there you go. So I made that profit. That much money, cash is in my bank, closed. But there was also another opportunity here, which I'll talk about. If I'd been in the market, I would have definitely taken that trade and we'll see how I would have managed it, etc. So we'll talk about that. But now, let's go to the first candle of the day. So this is the exciting thing about price action trading. When you start to put things together, it makes sense. By the way, a little bit of marketing. Wednesdays at the market, the second Wednesday of every month. It's all available for you to have a good look at it on the Actions to Wealth platform. Wednesdays at the market with George, the second Wednesday of every month. 8 hours in the market with me, different times. Asian Open, European Open, which we're in, US Open, and then an hour at the end to talk about money management. How do we manage our money? That happens for free for everyone, second Wednesday of the month. And then by subscription, 12 months of subscription, you can pay upfront, get a discount, or you pay month on month. And that is available. So you then get an opportunity to spend another 16 hours with me every month, which is the third and fourth Wednesdays of the month. All right, so correlation. Look at the first candle of the day, the very first candle of the day, bear candle. Okay, that for me becomes the first tick, that the bears control the first candle of the day. So it's correlating to those 3 days that I saw. So right from that moment, I'm happy to start looking for opportunities to sell. Okay, so as I look at that, the probabilities start to work in my mind. I'm always looking at 100% certainty that one of two things will happen, that we end up with a trend or it's a reversal of sorts. Then I know if it's trend, 60% chance, a reversal is 40% chance. Okay, but so far, bears control first candle, and I am happy. Then I just, because I'm not in the market, I'm not going bar by bar, but if you're in the market, you go bar by bar. Then I just want to see what happens in the first 18 candles, first 2 hours. Are the bears who controlled this first candle exhibiting strength? Now, if the bears, so there's a lot of information being shared here by the market. Okay. Just be a little bit more precise with my open, the magenta line. So look where the market closed yesterday. We closed here, the US session. And there was a gap up. Now, if it's a gap up, means something happened in those moments of time and the bulls had the opportunity to accelerate the market up. Yeah, that's why the gap up, but the bulls failed to control that opening candle. Then with a strong bear candle, okay, that's why I'm saying the bears were strong or right there. But then I look elsewhere. It would have been beautiful if the bears had come and broken below the low of yesterday, etc. But they didn't. But that does not mean that they are weak. Okay, there is no bullish strength all through here. Okay, the bulls that had tried to give up were strong, would have had successive bull candles somewhere. The biggest bull candle came as an attempt to break above the trading range and immediately failed. Okay, so, and the bears were able to put 3 successive strong bear candles, okay, within the first hour. So the bears are very strong. Then the bulls come in and you got to start assessing the strength of the bulls. Always look at the breakout point and what happens there. So we had a breakout, attempt to break out, but it failed. And immediately that it failed with that doji, the bulls reasserted themselves, excuse me. Bulls reasserted themselves, but that was a breakout candle and they failed in just bull weakness. So at that point, nothing that's taking place is assuring me that the bulls are in control. But we have a trading range. That low, that high. Measured move every time you see some form of a trading range. Whether it looks like this or whether it's horizontal, you have to just get into the habit of just put the measured moves in. It gives you information. So there's a measured move. Now, what does that tell you? It says to you, if the bulls are strong, they want to get to there with their move, but the bulls did not get there. So the bulls are not strong. In fact, we have this 3 push pattern. Attempt by the bulls to accelerate fails. Another attempt to accelerate fails. Another attempt to accelerate fails. So 3 pushes is a wedge, which is an indicator that someone is resisting the attempt for the market to accelerate. So the bears are strong in this area. That's all information that's been provided for here. So the case that the bulls are, the bears are strong, which is what we've seen on the 3 days that we looked at on the daily time frame, 3 days of strong bear price action. So that case has been validated. You just want to find ways to get into the market. Wedge top, failing to get to measured move. You want to see if you can get, a pullback and a lower high. Market does pull back and does create low highs, but there's absolutely no ways you can get here. No high tests, no candles, no double tops, nothing easy for you to get in, so you leave it. Okay, we'll get to a double bottom. Okay, the bears come and try and break beneath that, but they fail at that point. So a double bottom is created. The double bottom is created, gives the bulls an opportunity to get into the market. Okay, so the other side of it, well, and I'm always prepared because of the probabilities. Okay, so from what I saw with my analysis, which I started off, I'm 100% certain that today is 60% opportunity. That's going to be a bear trend day. But if it's 60% opportunity, it's going to be a bear trend day. It means 40% chance may just be a trading range or it become a bull trend. So if anything sets up in here that says to me, hang on a second, the bulls have got a clean setup, I will take the bull trend trade, knowing that if I get up here, I can reverse out of it. Then I'm trading as a trading range. But if you look at this double bottom, there's no pattern here that shows you that you can trade. Yes, the market turned, but there's nothing as clean as this. So there's nothing for you to do. Okay, we get to the middle of the trading range that's forming, 2-sided price action. Bulls are not showing successive strength. We come back again and create a higher low, but you're not going to buy a higher low up here in the middle of a trading range. Okay, so you'd wait, and you then get a breakout above this trading range by the bulls. Got a wedge top there, breakout above the wedge top, fantastic. But the bulls are only getting to that measured move at that particular point. Okay, this is just a line that I put for the high of today. So they can't even, at that point, you don't know what's going to happen, but they don't even get a chance to break above that measured move and follow through. So the market fails at that point. Okay. So this line here, I put that in later. But at that point, I have a failed breakout above. That point was the high of the day at that particular point. Failed because of this doji candle. failed breakout above the measured move of the early morning trading range, then a doji, more signs that the bears are strong. Okay, nice enough high test by a bit of a doji candle. Just want to wait to see if I can get a double top and lower high to trade. Still does not materialize. There's nothing for you to trade here. Okay, because of two-sided price action, not decent enough candles. Then we have a huge bear candle. Okay, and the bears have an opportunity to follow through, but they fail. So again, the market tries to bottom here. Again, we have a fair enough attempt by the bulls to reverse the market. And what you would want to see is confirmation strong bull candles, not all of these dojis. Get into the moving average, maybe a higher low. But we don't get that. But instead, we have a 2-bar reversal at the moving average, but tails at the bottom. There's nothing for you to trade. Then the bears attempt to break below this low and the open of the day. First attempt, so that's a pullback. Market went up. First attempt failed. Second attempt failed. Third attempt failed. A decent enough inside candle. For the first time, we have a decent enough trade for the bulls to take. Micro wedge. Micro means it's a small pattern. Okay, it's not a huge pattern where you'd go 1, 2, 3. Still as effective, still the same forces that create a micro wedge as the forces that create a large pattern. So you didn't get an entry here for the bulls. Could you have taken that and said, okay, 2-bar reversal, there's a low test? You could do that if you wanted. But remember, it's always where do I put my stop? Okay, measured move of that pattern, you could have taken that and put your stop and aim to get to the top of the trading range. So that could have been legit if you wanted to take that. I wouldn't take that personally because of this huge bear candle. I want to see a little bit more confirmation that the bulls are in control. So in terms of trades for the day, remember, my mindset is short from my early analysis, first candle, from the 3-day analysis, from all the other stuff we saw on the daily time frame. So I'm not taking any longs. And I've explained that before, that if I'm thinking long, I want to take shorts because my whole mind becomes geared to taking those trades. And it's hard to reverse. So if I'm thinking short, I'm just going to observe and say, oh, fantastic, good for the bulls. I'm not going to jump in and then awfully jump out. I think from experience, I get myself confused. I may break even and not lose money, but I lose more opportunities. Okay, so let's just change the color of that so that if you keep in track of this. Okay, so that would be a good trade to take for the bulls, but you need a measure move stop. I wouldn't take it because of that. But if I was thinking long, if my whole daily analysis was thinking long, when I saw that attempt by the bulls to break out middle of the trading range, and then this pullback, 1, 2, 3, that's a wedge pattern, and then a decent enough low test almost inside candle. That you have to take. There are some trades that you just have to take. If you doubt in yourself, then reduce the risk. Don't trade 1% or 0.5%, trade a quarter, but get into the trade. That would have been a decent enough trade to take. And if you're taking that trade, then your stop must be here, the low of the day. Okay, and your objective is just to get to the top of the trading range. So if you took that, 6 pips. By the way, when I'm trading the euro, if I see any stop range that's less than 10 pips, I just got 10 pips because of spreads and stuff. So I'll put the stop at 10 pips and aim to get to the top there and make 1-to-1. Decent enough entry candle, That's good for the bulls. So if you took that trade, that would be fantastic to enable you to pull your stop from here, bring it down to here. Correct place is here, or whatever it is, 10 pips. Bring it up to here, you've reduced your risk. If it turns, you get stopped out at a third of the risk. And you want to see what happens there. Who knows? You might get acceleration and they break out above there. Remember, my mindset is still bearish. Bulls get to the top of the trading range, but there is a wedge pattern again, which confirms bearish strength. Attempt by the bulls to go up fails. Second attempt fails. Third attempt fails. Okay. At this point, at the failure of the high of the day, get a doji, get an outside candle, get another outside candle. That is breakout mode. Outside candles, breakout mode. Breakout mode means the pattern that's before us, and market will break out one way or the other. Now, if you were in the market, so that trade that I'm talking about that I took down here, you can see the profit at the bottom. That trade I took down here because I happened not to be in the market at this particular point. Okay, so, you know, I was out, gone out, exercising, and come back, aiming for the open of the market, and the market is open here. You look at your charts and it's like, man, I should have come in 30 minutes earlier. But that's pretty pointless, right? Because you didn't come in 30 minutes earlier. You got things to do. Do your things. There's always opportunities. So let's have a look at this. So if you're in the market and you're selling, so if you're a bull, you take your profit at the top of the trading range. You don't wait and hope and wish that it breaks out. There is a clear reversal. Bank your money, leave it, and wait for another opportunity. But bearish, remember, I had this is here as a higher high. Now, I have an attempt by the bulls to go up once, failed, bulls to go up, failed, and third attempt. Okay. When I see a wedge pattern like that with an overshoot somewhere in here or at the end, that means the bearish forces are very strong. So if I was marking this particular pattern, which I'm going to do for you, now, one of the things you'll get used to with price action, there's not that many patterns to get to understand. But what happens is the things may come in bunches or they may be nested. A nested pattern is where you've got a large pattern and then small patterns within it. All of it confirming the existence of bullish or bearish forces. In this case, it's bearish forces. So if you're in your early stages with price action trading, you don't have to trade 8 markets like I do. You can just trade one, you'll make good money. Become very good at it, and then you can increase number of markets you're looking at. Why would you increase number of markets you're looking at? Well, because then, you know, like I showed you earlier on with my view of the 8 charts, I can just sit and wait when a particular market gets to the buy zone or the sell zone, then I jump into it while others are doing whatever they're doing. So confluence of factors, nested patterns, confluence of factors, many things coming together to confirm for you what you should be taking a trade. Nested patterns, think of a nest, there's patterns within patterns. So there is a large wedge. Market went up once, twice, 3 times. But also at that point, there is a micro wedge, micro small pattern happening in a few candles. Market went up once, twice, 3 times. Okay, we also have the high of the day. That was the high of the day. An attempt to break about it failed. Follow through failed. Follow through failed. So also here, an outside candle. This one is outside of that, and this one is outside of that. So outside breakout mode. So you got 1, 2, 3, 4 things happening. And if you're selling, you're going to be saying, man, this is it. Now I'm ready. I've got my calculators ready. I know how to work out my risk levels. I just want to see this thing set up, and then I'm going to jump in. Okay. And at this stage, you are 100% certain that there's a 60% chance the market is going to go your way. Okay. But at this stage, actually, so it's still a reversal trade. There's still 40% chance, but everything is set up. The more of the factors set up, the more the probability increases. Okay, so here's a high probability, and the question becomes, what's next? You then see these two candles. This is a breakout. So breakout from all these confluence of factors, from this top, this wedge top, that double top breakout. We don't trade breakouts, we wait for the pullback and wait for the lower high. Okay, so I should have made this a different color, just we can keep track of it. Let's use lime. Oh, you can barely see it. Let's use green. Okay, so just to differentiate what's created that particular top and why it is the probabilities, every time that you have an additional factor that come into play, your probabilities increase. Okay, so this is so strong now, and that comes into play. There is absolutely no reason for you not to take a trade. So that's where you take a trade beneath this bear candle. Stop at a measured move. You always put the stop at a measured move when you take in a reversal trade. That's where you put your stop. And your goal is to get down here. But if your goal is to get down here and you are selling, and that's your whole thesis from the morning that you're going to sell, I prefer to manage my trades to see what happens when I get down there. Because instead of just selling the profit, the market might accelerate down as it did here. But if you're going away, if you have to go to work or do something else, put your take profit there, just above the low. I mean, the low of yesterday is a key support here, just above that. You know, you still make very good money. So if you've done that, 11 pips, 1-to-1 return there, that would have been perfect. Okay, so that's a trade that you should have taken. Now, if you didn't take that trade, remember we said breakout. That's a first low, first breakout that's cleared the lows. So that could be, we call that a low one. There's a low two. Here, the market went up, came back, and created another low three. So if you wanted, you could take a trade beneath that, but that's very risky. If you're taking that kind of trade, it's a dodgy trade. I wouldn't recommend you do it, just let it go. Okay. Could you take a trade there? You could take a trade there if you wanted, but if you're taking a trade there, your stop is still. If you're taking that trade, I had a market because I wouldn't take that trade, but you can still take it. There's nothing wrong with it, provided you are prepared to put a wide stop. Now, where would you put a wide stop? Because you are selling beneath a doji. A doji is a trading range. Okay, most breakouts fail, so it might fail. So you need to put a measured move stop. There is a high of it. There is a high of the trading range, low of the trading. So your stop would be here. Perfectly fine, because if it fails, and I've seen this many times, it will come back. Maybe you want to test that to go up a bit and then accelerate down. So you don't want to stop above there. So perfectly legit if you want to do that. Now, I came into the market and all of this beautiful stuff had just happened. And I saw that and I was like, oh, wow, what a pity. But I'm still going to sell. So I saw all that happen. The sell indicator for me was here. So if you had been in the trade and if you're managing your trade, you see the break beneath that, you see the breakout, follow through, and then you see all of this sideways price action. You've got a choice to take. We are now beneath the moving average, and not the moving average. Firstly, we are above the low of yesterday. So the bears were strong enough, but there was a tail at the bottom. Then we went sideways. It's a decent enough pullback. It's a trading range pullback, so it's a legitimate pullback. And then the market is holding beneath the moving averages. So if you want to trail and see what happens, you pull your stop down from wherever it is and you trail your stop to somewhere here, okay, or above the open of the day. So let me just put it in. So if you have a chance when these videos are posted, just go back to the video and just work through all this stuff that I'm talking about slowly and add it onto your strategies. So you could put your trailing stop just above, not above the high of yesterday, I mean the low of yesterday, just above the open of the day, and say, well, that's the bears are going to defend that because there is a breakout, there's a follow through. So that could be your trail stop. Make a note of it. Trailing stop. Looks a bit messy, but it's absolutely fascinating when you really get your mind around price action trading. The only fundamentals I'm looking at is when there's news announcement. Otherwise, I really am not interested. The market's going to give me the information. When there's news, I get out of the market. So there's your trailing stop. Okay, and then when you put a trailing stop, that means you're not worried about what's happening. If you get stopped out, fine, you look for opportunities to get in the trade. Okay. So I then saw that unfold. Now I was in the market. And the market is going sideways, trading range, price action. And I wanted to look for a wedge to see if I could sell, and there was nothing. That tail was a problem. First pullback, second pullback, third pullback. That would have been a wedge. Market went up once, twice, 3 times, but tails. I mean, by the time this materialized, I wasn't comfortable with the trading range. So I put in for myself this measure. Where's the high of the trading range? This measured move, low of the trading range. And I say to myself, if the bears break beneath that, they want to get to the measured move. Okay, I'm still selling. I still have a mindset to sell because we are beneath that low. So the bears did get to that measured move and the market turned. Fantastic. I have absolutely no problem with that. So I was happy. Whenever I see a breakout, I kind of look at the midpoint. I want to see if the bears are able to turn the market here out of look to sell, but they didn't. They got back to test this trading range here, which was a pullback. That's where I'd marked one as that whole trading range, the high of that trading range, wherever it may be, any of these highs, was a level of resistance for me, which I marked as 1. Then I want to see double tops, lower high double tops. That's what I was looking for. So when the market then created, let me just move this, I'll explain what this is. When the market created this lower high here, I marked it as 2-1. Why 2-1? Because 1 is the top, 2 is the one is the first top, 2 is a lower high double top. But I don't trade the first lower high double top. I wait for a second pattern. Just like here, we don't trade the 1, we want to trade the 2. Okay. I want to see if the bears are able to give me a second entry. So then almost a perfect repeat of what took place earlier on. Okay, at the lower high, so I'm very happy. Lower high, calculators out, everything happy, writing things down. By the way, when I say calculators out, I think I've shared this before with the guys. I mean, I'm really, I don't know if you can see, really old school. So I write euro versus the dollar. I've got my kind of 3 kind of dots here. There is the stop loss. Write it down. There is open, write down. I don't have the profit in because I'm going to manage my trade. Okay, so that's written down before it goes on the order ticket, so I don't make mistakes. Okay, so there I was already breakout, pull back, and at that point I'm saying, okay, George, if we get a 2-bar reversal, we have to sell. Okay, but where do we put our stop? I'm not going to put my stop anywhere in here. I got to look at the measured move. That's what this is there for. There is a low, there is a high of this pattern here, and there is my stop measured move, which is almost where you put your trailing stop. So I worked out that my stop will be there, and then I just waited. And as this candle was forming, I looked at this candle and said, man, where is this likely to close? Because I want to be ready. Okay, so now that's a 23 pip stop. So as it is forming with a few seconds to go, I kind of work out the price. And most times I just look at the candle before and I say, okay, if we close beneath the body of this candle, I want to get into the trade. So as soon as it closes in this low, hit place order. I'm not trading in the market. I place the order in the market and say, trigger me in if we accelerate beneath that, and we go into the trade. Almost a repeat of this pattern, okay? But it's a lower high double top. This is one of those which, you know, I gotta get my 11-year-old daughter and say, listen, child, as soon as you see this, okay, just press the button. This you have to take, guys. That trade you have to take if you're in the market. That was a bit more technical, but that trade you have to take. So I took that trade. That's the profit that you're seeing down here. Okay, took that trade, and I want to manage my trade. So it carried on down here. I don't leave it. As the market got here and a tail was created, they're going to say, oh man, I was hoping that would break out beneath like that, but we didn't. So I closed the trade, okay, at 1.05963. So somewhere up there. $5,963, because I'm manually trading this. And I gotta make a quick decision. Now, if you can't make those kind of decisions, okay, so I was in the trade down here, and as it turned pretty quickly. I just closed the trade. If I had been super fast, I would have closed in here, but I waited, then it went down a bit, and as it started to turn, and it turned pretty fast. If you look at the 1 minute time, you see it trend pretty fast. Then I just hit stop. Okay, so if you don't want to do that, and if you're worried about missing out a few profits, then you just put a take profit above that, get your beautiful profits. But if this hadn't materialized, if it had been like that, I would have held onto the trade and try and find a way to trail it. As it is, we've been talking. I'm still looking for sell, and I'm gonna look for sell somewhere up here. What I'm doing with my charts at the moment, this is live as we're going. See, there's a measured move of this little trading range. I'm not gonna jump into anywhere here. So as far as I'm concerned, what's taking place presently is still part of that second touch. Okay, so first touch, second, that's all part of it down there. Good for the bears, good trading forces. But you know, whether it accelerates or not, I want to see the market coming up. I want to sell a little bit higher. I want to sell low. All right, guys, we are 1 minute to go. How is that for timing? I really thought I'd walk you through this, and it's always good to talk about trade that's actually materialized. The left, don't worry about the quantum of the money, it doesn't matter. I'll tell you what, so that was a trade 24. So it was just, we'll call it 1-to-1, thereabout. All right, so hopefully you get a chance to go through the video and pick it up, and we will catch up again. My in the office, thank you very much for hosting the webinar. And guys, we'll see you Wednesdays at the market, the second Wednesday of every month. See you in May. Catch it up on the Actions to Wealth social media platforms, and let's trade 8 hours together. Thank you, guys. Have a great day. Cheers, mate. Thank you. Bye-bye.